Today's episode of Stablepilled is brought to you by Limited, the global business banking platform built for founders in the US, LATAM, and APAC who operate across borders. Limited makes international scale seamless. You can open a US bank account for the US or non-US entities and accept funds locally with accounts in the EU, Mexico, Brazil, and the UAE. They support cross-border payouts in over 80 currencies across 300 local payment methods, and your team gets premium Visa cards shipped globally that can be used anywhere. I've actually been trying them out so far, and I found their method for converting between fiat and crypto very easy. I was just in Mexico City recently using them, and I can tell you that is not the case for many products. So stop letting legacy banking slow down your growth. Go to limitedapp.com and unlock borderless banking today. All right, I'm happy here today to be on another episode of Stablepilled, today with Chuk Okpalugo. How's it going?
It's going really well. Thanks for having me.
It's cool. I don't know if I've had another podcast host from the stablecoin space on my show yet. We've had some VCs in the space and all that, so excited to have you here today.
Nice. It's like a little crossover.
Yeah, exactly. We're just trading notes here. So a little bio on Chuk. He's a stablecoin operator, investor, and writer. He spent several years building products at Paxos and now covers the space through the stablecoin blueprint. He's also exploring next things, and he just brings a really, in-depth, practical perspective. He's certainly one of the sources I go to when I want to make sure I know what's happening in the stablecoin space.
I appreciate that.
So yeah, tell me a little bit about what's going on in your life these days. What's the hottest and latest for you?
Yeah, lots going on. As many folks know, I've been working on a range of different things in the background. Of course, we have a lot of media that we work on out of fun. So we have a newsletter, we have a podcast, but a lot of it is just kind of the synthesis of other work, and that's kind of diving into kind of building something new. But that journey is still ongoing, so maybe that will be left for another podcast that we'll talk about in the future.
Awesome. Well, yeah, let's talk about the state of what's happening in the industry today. It's always like the last couple of years have just been a freaking roller coaster, but it does feel like it's maturing. Things are changing. So I'm just curious, as you look across the whole industry, like what are some of the themes that are top of mind for you these days?
There's so many, and I definitely feel like I've done several different rabbit holes. So taking a step back and thinking about the wider space, the shift from, I think it really started slightly pre the Trump administration coming into power. I think there's a lot of work being done on the Genius Act, the stablecoin regulation and so on, but it just kept on feeling like it was going to drag on and take a long time. That all shifted with the administration, and seeing that kind of kicked everything off, and that obviously led to the Genius Act being passed. Lots of folks who were planning already before that got into action. So the bridge acquisition, I think, is the key industry catalyst for many folks who are outside the industry, seeing a major player such as Stripe acquire a stablecoin infrastructure company. And then since then, the attraction of large financial institutions, large non-financial institutions into the space has just been nonstop. And I think if you look at the press releases and the announcements and the acquisitions and the M&A from 2 years ago through to now, it's been almost weekly. So that's the backdrop. The regulation is the key thing. It's really enabling the largest of players to enable their technology, from the likes of JP Morgan to the cross-border players, banks globally, the consultants, and all the other kind of larger, more regulatory focused, or call it conservative firms globally have kind of entered the space. And that trickles down all the way. Of course, the startups were already in business, but the underlying infrastructure, i.e. the banks, Swift, and so on, getting involved has really shifted everything along. And so that's the backdrop. And so I kind of start with there because that's kind of driving everything. Many startups are serving the banks because they're a critical piece. Banks are working on tokenized deposits. That's a critical piece. Then you've got the stablecoin issuers, who there are like 10 plus white label stablecoin issuers enabling companies to launch with their own brand. And then you have Open Standard with OUSD trying to create a different type of consortium than what has come before it. The infrastructure providers have exploded, and more of them are enabling startups to build financial products. And so I think of that as a new wave of banking as a service. And so now you're getting lots of small fintechs. Some call them stablecoin neobanks for consumers, for businesses, and other types of, call it merchant acquirers and other payment processors, all popping up, built on top of this technology. So those are all the core waves that I see in the kind of payment space. But underlying that as well, I mentioned the regulation that drives things on the capital market side as well. Tokenized equities, tokenized treasuries, and other like real world assets. Prediction markets have come to the forefront in terms of things that were very, very busy during the election, but now have become more popularized and being embedded into consumer applications like Robinhood. And so all of this to me is building on digital asset infrastructure plus clear regulation has come out since the Trump administration. And so those are the areas I tend to kind of focus on. Bank innovation, banking as a service innovation, of course, cross-border payments, and then tokenized real-world assets.
Okay. And do you think of them all equally today, or is there some that draw you more than others?
For different reasons, but I guess this is just something that I find interesting. So like they're all very interesting to me. When I was at Paxos, even before Paxos, I've worked a lot in private equities. What I mean by that is, one of the first startups I joined after business school, it was called EquityZen. It was a marketplace for private shares. And so, what we were a marketplace that connected startup employees who had their shares vested at, like, say, Dropbox or like Lyft, and were sitting on hundreds of thousands, if not millions of vested shares. They wanted to get exit value for them without waiting for the company to go public. And so we would connect them with buyers. And so even back then, we were thinking about how to turn what we had, which was kind of a ledger system where we set up these SPVs to hold the shares. The SPVs would then be held by the particular investors. And we were thinking, all this stuff should be on a blockchain. And it was never the technology, because these things didn't really move that frequently. It was always about the regulation and making the regulation work with the technology. And so I've been interested in, opening up financial markets for a very long time. And then when I was at Paxos, we worked on the kind of plumbing of tokenized equities, and that's the clearing system. So we worked a lot with US clearing brokers. That will probably not mean anything to anybody on listening to this.
That's not true. We got some nerds on this call.
Okay, so to those folks who know what that means, really going into the plumbing and trying to understand how to make it more efficient. And we had an account with the DTCC. We were trying to make the then T+2 system work at a flexible settlement, so T+0, T+1 in a more efficient way. And fast forward several years, and we're here in 2026. DTCC is partnering with Canton, and Securitize has their own version of a kind of approved settlement plugin into the DTCC to enable folks to be able to get their shares out and tokenize it elsewhere within, and this is the key part, within a framework that fits in with what is allowed from a regulatory perspective. So there's so much shifting already. So that's a long way of saying the tokenized world assets, to me, I have a soft spot for it because I've worked in that particular area. Payments also, because just as someone who's lived in different countries, immigrant family, like you are just naturally akin to thinking about cross-border payments. And so whether it's payments or whether it's capital markets, both of those things I think are super interesting to me. And I think one way to get that to the people, i.e. individual consumers and businesses, is fintech, is banking as a service, right? Is all the infrastructure to enable people who, they can code with Claude Code and with AI agents, but then they need to still work with folks to figure out the regulation side and compliance to build more kind of personalized or vertical applications for end users. And so we can talk about regulation, we can talk about all this infrastructure and all these things in the back end that most people don't know about and don't really need to know about. But really the way that it impacts individuals and individual businesses is the entrepreneurs who build at the application layer. And all those entrepreneurs need the infrastructure to be working in a highly reliable and highly regulatory compliant way in order to produce those user experiences that actually have the impact on the user that we're looking for. So yes, there's no specific thing there that is like, oh no, I'm really drawn to this, I'm really drawn to something else. All of those things have a kind of special place for me. So that's why I continue to follow them. But importantly, they will move and adapt at different times and different
Okay.
paces.
Yeah, so you brought up a couple things there. One I thought was interesting is about regulation because we got Genius, but now Clarity is at this in between stage. So, how do you think about the importance of Clarity, and do you think Clarity is going to pass this year?
Really hard to say at this point. It's been such a roller coaster. I don't hold my breath for it. I think that there are clear benefits of instantiating it this year. Well, in general, but there's an area of politics that kind of goes beyond just the utility and the economics of a particular aspect or concept. There's so many things going on that it's just kind of like, okay, well, what can we do in the meantime? And I think the industry has to be adaptable. And so I think that I'm not making plans based on the Clarity passing or not passing.
I
But I'll
see.
put it that way.
Yeah, to me, it seems like it really could not pass this year, and we could have an administration that's less pro crypto. And so a lot of the forces that have been driving some of the shift could change over the next 2 to 4 years. And so I'm just curious, like, how are people preparing for that? Are they preparing? And if not, like, why? Yeah.
Yeah, I mean, I think just to be prudent, assume it doesn't pass. What does that world look like? And I think if you are in a position to establish oneself and acquire licenses in a window of opportunity, one should do that. And I think we're seeing people do that. The number of OCC bank charters and trust charters being passed is so different to the past couple of years. I think it was like eight bank charters since 2025. I think that's a stat, but it's a lot since post the post COVID and also post the financial crisis. So I think that's a smart move, right? It's like, okay, well, like as long as you do the work, and it's a lot of work to maintain the compliance and maintain the ability to hold those licenses, then depending regardless of what happens next year post Clarity, you have access to parts of financial infrastructure that kind of solidify your position. And what I mean by that is, in the era of a couple of years ago, it was not a given that you would have a bank account if you were a crypto company or somebody who's like interacts with the digital asset sphere. If you were just on the wrong side of the political whims at whatever time that was, you may not be able to get banked, right? And that is a thing that is has been tough for the industry to kind of work through. And it's not over, and it's not just fortunately it's not as simple as, okay, a law is passed and therefore it's going to be fine. It still is politically charged. This industry is still politically charged. I'm hopeful that stablecoins do kind of break out slightly. Like tokenized assets are starting to break out. The more that the largest financial institutions in the world have a stake in this game, the more that it will become not in the best interest of the populace to be against a particular industry. But I think crypto still has a bad name. Stablecoins are still this kind of strange intermediate place that I think doesn't have as bad of a name yet, and so hopefully we can keep it that way.
Don't screw it up, Chuck. Don't screw it up.
Yeah, exactly. I mean, it's like hopefully we don't get an FTX, we don't get any other scandals like that. But
yeah,
there's a lot of work to do. So yes, I think I think it's prudent to just assume these things don't happen and build for that future. And then if it does happen, there's upside.
Yeah, I have heard people say, once a certain number of billions or trillions of dollars are going through tokenized money markets or certain, BlackRock or large TradFi products, regulations are going to matter less. I do also, well, let me just get your thoughts on that before I go to the next point.
Yeah, I wouldn't frame it exactly like that, but I think I know what you mean. It's not, I think it's just having more buy-in across the landscape.
And
right.
Risk,
I think
oh, go ahead.
Well, yeah, I guess whenever I think about politics, I maybe this is cynical, but it's the people who then influence their representatives to then represent a position, right? And so, the Clarity yield conversation was very much driven by one large constituent, banks, another large constituent, like crypto, and both of those had influence, and therefore we're in this back and forth. And And I think that as more and more parts of the economy benefit from the technology, and again, which is why like stablecoins and crypto, I think, have a different narrative. Digital assets, different narrative. Tokenized X, different narrative. As more and more of the constituents benefit from the technology, they will support things that are in their best interest. And so, yes, that's why I agree with you. You know, BlackRock is one part of the kind of large financial infrastructure. So are the largest banks. You know, we have JP Morgan saying, yes, of course, blockchains. It was always about blockchains. I've never said it wasn't, you know, right? And then you have I think that will continue, where it's in folks' best interest and where people can make money. And so, like, look, it's a technology. I think the more that we can enable folks to power their businesses with it, and to achieve their goals with it, the more that they will want it to remain. And in situations where that's just not possible because it's antithetical to their business model, you're always going to get pushback. And this is not the first time this has happened.
Yeah, very cool. Okay, we can move on from regulation. You said a couple soft spots for you were around tokenized RWAs and also payments. So maybe let's just double click on each of those a tiny bit. What are some areas that you're excited about today in the RWA tokenization place?
Yeah, across the stack, I think the initial, the first part of like when I think about real world assets, there's so many different types of asset classes. So how does this interact with on-chain and on-chain tokenization? Well, I think the first thing people tokenized was dollars. All right, that's kind of clear. $300 billion of stable coins, you know, quote unquote. And money market funds or treasuries themselves, direct treasuries, I think, are clearly the next or the second most kind of understood and adopted. And then you can keep going down the curve where you talked about tokenized treasuries, then there's money market funds, then there's other types of funds, then there's private credit. And we haven't quite got to bonds just yet, although there are people building in that space. But either way, there's kind of two areas that I'm excited about, well, two conceptual approaches that I'm excited about. Just the idea of getting access to things that you want, you understand, but for whatever plumbing reasons you don't have it. That's usually best presented by showing international financial applications who would otherwise need quite expensive and slow broker-dealer relationships to have access to US stocks. And that has become much easier over the last couple of years. People were doing it like you could open a brokerage account in the UK and get US stocks. They'll charge you an arm and a leg for the FX, and the timing was always awkward because you have to wait for the US market to open whilst the UK market is open. It's just not ideal. So you could do it, and I'm sure other places have slightly better access. But now with kind of the tokenized infrastructure, more countries can get access. And you know, there's a whole other conversation about personal financial knowledge and how people think about investing. But most people who are thinking about investing, they've heard of or are interested in buying SpaceX, you know, the Mag 7, and increasingly soon Anthropic and OpenAI. And you know, whichever way you want to look at it, hey, people are adults, let them do let them do what they want to do, let them take risk. Or you say, hey, look, if AI is going to go and take our jobs, at least let people have a stake in the company that is doing it. Whichever way you want to look at it, I think it's a good thing to give people access. Also, it makes global capital markets more competitive. And so if you are a country that has not really worked on its, you know, domestic capital markets, and your customers, I should say, constituents, your populace has access to the US market, then that is going to apply kind of soft pressure on you making your markets more accessible. So there are all these benefits of opening up kind of capital markets. So that was one angle. And I think the second angle is just the efficiency. It's not purely for non-US folks now. This is just, there's actually a lot of cost in the system, and this is stuff that people don't really see. And if you're using Robinhood has an incredible UI. They kind of plaster over all the inefficiencies and can make you have a great experience. And so you don't necessarily see it, but there's a lot of plumbing that is high friction, that is costly to paper over, from, you know, international settlement to 24/7 liquidity management, FX, and so this one's a bit of a harder concept for most people to kind of see on the day-to-day, but the impact of solving the plumbing is that you're going to get more competition, because it's easier for a smaller company to launch a stock investment app, even in the US. And so we don't see that for many years, but the impact of fixing the plumbing is that there's going to be a lot more innovation in and for traders and for firms who work with kind of hedge funds and prime brokers to structure special types of I don't call them deals, but investment products. They become much more easy to structure. And what does that mean? It just means that there's a lot of different ways to get the risk exposure that you want as an investor. So that's all very, very exciting. So that's what I would say on the kind of RWA side. Just between stocks, I said tokenized treasuries, money market funds, and stocks, plenty. There's a whole other conversation to have about other private assets, like real estate and other things that are less liquid. I'll hold that for another time. But for now, I think it's clear that the volume in tokenized stocks is going through the roof, and it's really a reflection of global demand for capital markets.
Yeah, totally makes sense. Money markets, bonds, private credit, these are definitely things where personally I'm interested in not only efficiency, but also transparency. Because you see like a 2008 crisis and all that was driven a lot by lack of transparency in some of the pools of money. And obviously we're not going to completely fix that and make it completely all transparent. There's problems with that too. But building in that direction, I think is a good idea.
Yeah, and I think that's a good example for plumbing that most people don't see, but the financial institutions that needed it, they really needed it at the time, right? And there's transparency into what assets you're holding and where the underlying assets come from, and then there's collateral the efficiency of how quickly you can move collateral. And so one of the key things during the Lehman crisis was, yes, there's a question of solvency. People don't actually know how much these assets were worth and who was holding the bag, but then even if one had to shore up themselves, they couldn't move liquidity quickly enough. So there's multiple things that compound on top of each other, and these things get fixed. But this is the stuff that I think internally within financial institutions who are focused on managing risk and plumbing. Oh yeah, big topics, very interested. Just doesn't really make it to like the end consumer, right? Doesn't really make it to the end business. And so while I am excited about that, having worked in different teams at different firms tackling problems for the end user versus the intermediary versus like companies who are part of the plumbing. While the plumbing work is necessary, I think it's harder to coordinate folks to make it happen because of the lack of visibility that it gets.
Absolutely. Yeah, I know in the energy space, it's like, who wants to spend more than 5 minutes looking at their energy bill a year, if even 5 minutes? And so it's like, to get people to think about all the needed changes, it's like very boring. And you can make the same thing here. It's like a lot of us just want this stuff to work better. And so, yeah, it's boring, but super important. And therefore, some people want to work on it. And for some, it's harder to coordinate and galvanize the interest needed. Yeah. Okay. Let's hold off on payments for a second. I'm curious if you have any hot takes, things that you think the industry is not thinking about enough or thinking about too much. I can give you an example if you want one, or if you
let's go.
Okay. Another guest recently said was, this is more crypto industry focused hot take. He said that he thinks we're overbuilding payments infrastructure, similar to how we were overbuilding block space for your last cycle and having all these big fundraising and blah, blah, blah things that were happening around that. So curious if that spurs anything for you, or if you have any kind of spicy opinions you want to voice.
I'm going to say it depends. And then also,
because what a grad school answer. When I was in grad school, that was the best answer. Just always say it depends.
Yeah, well, I mean, in this case, it does. The number of permutations of payments or money movement is just too broad. It's too broad for someone to say it's overbuilding. Yeah. There's corridor, payment type. Are you pushing? Are you pulling? What's the size? What's the speed requirement? There's just so many different things and that's just a settlement, let alone the information that you need to coordinate, let alone, the regulations around the type of money movement that you're making. And so for someone to say that, we're overbuilding, I'm sure we probably have too many virtual bank account on-ramps products in X place. Okay, sure. I wouldn't disagree there. But I think there are a lot of pockets that are still underserved. So I agree and disagree at the same time. Better than it depends. I'm going to say I agree and I disagree.
That's good. Like underserved pocket's interesting to talk about if you want to talk about that. Yeah.
Yeah. Well, I say underserved there are people who have figured this out. You go and talk to founders and teams, and they'll say, "Oh, we are a regulated on-ramp in Europe for large exchanges globally." And you're like, okay, that seems like a pretty crowded market. Like, how is that not crowded? And it's like, well, actually, because of this and this and this and this and this and this many licenses, and then Mika happened and then CASP happened, and it's actually there's only like 2 of us. Like, oh, wait, so it's not crowded at all? No, all right. And I think if you spend time on X or LinkedIn, and you look at the million market maps that are out there, you assume that everything is really busy. But especially as regulation changes, and the requirements of a particular type of payment are different. Is it first party? Is it third party? Is it for consumers? Does it need to be instant? How much risk are you taking? Or is it for businesses? At what limits? The requirements change, and that dictates the capabilities, and that dictates how many companies are competing in that space. And so, there was actually more underserved infrastructure than one would expect. But I think from an investor perspective, or even a founder perspective, it may be underserved today. But then the question is, okay, well, how defensible is it? If the folks are making millions of dollars because they are one of 2 players or one of 1 player, and licenses are not trivial to get, not hard to get, but not trivial to get. And so then you have to say, okay, well, I'm making this investment. I'm going to invest in this company, or I'm going to spend my time to build this company or to extend my product to serve this use case. How much runway do we have? Not runway in terms of cash flow and burn, runway in terms of non-contested competition. Right. And so I think that's an interesting thing to think about, even before we get into AI and what makes things defensible in the age of AI. I think there's a kind of general consensus that licenses are still tricky to get. So, they're worthwhile. Banking relationships are still really hard to get, especially if they understand your flows. So those are worthwhile. So if you have those 2 things, that's quite defensible. But difficult doesn't mean impossible. And so there's a value attached to having those things, but it's not the only thing. Then you need to figure out a way to either own a corridor or own distribution through partnerships or through owning it yourself in order to accrue value. And so the big kind of, I guess where the person was getting at with the hot take about things being overbuilt is, where does value accrue? And there's certain kind of on-off ramp markets or certain cross-border markets where margins are compressing. And there are others where there's competition, but they're still quite juicy. So it's about finding the opportunity. And I think I don't think it's not really a hot take, but I think it's an interesting nuance that I've kind of seen over the last kind of 6 months or 12 months, which is this whole concept of like being able to go global, right, with stablecoins. And this combination of non-custodial wallets plus rented licenses through partners was like the big unlock. And then everyone figured it out, and then everyone launched a global neobank. It's like, okay, well, sure, there's a couple of that launched 2 years ago or so and have a head start, and they're doing really well. And there's lots who are starting, last year or this year. And look, they still have users. Now the question is, what will the market look like in 2 years from now? And are they going to pivot or find niches that they can go serve? And I think that it's been interesting seeing the different permutations of these neobanks, because even though the market enabled you to go global, having a niche ends up being a way to differentiate yourself, right? And so, some are regional. And so, hey, you can go global, but it's actually a regional product. Or it's global, but it's niche for a particular type of consumer. Mm-hmm. And so I'm seeing people think about this. There isn't really like a standout. There's a couple, but there's no kind of known consensus standout for, hey, this is a neobank, but it's a neobank for this particular type of consumer, and they're doing really well. Everything still kind of looks similar, at least right now.
Interesting. Yeah, the playbook, and I'm a little bit newer to this fintech world than you are, so I'm very excited to hear your thoughts. But the playbook in my mind for fintech success is hot burning wedge into you've captured that and you're able to kind of grow more steadily from there. Is that a playbook you buy, or how do you think about that?
Yeah, I mean, yes, in general, I think for many different things, I think it's just trickier it's like, how do you find hot burning wedge, and how do you compound on it? Because if you can find it, can other people find it? When it's really easy to build, like it really takes, we could, probably on one more hour on this podcast or two, you get API keys from Dakota or Bridge or other folks, and stitch together like the basics of a neobank. Like the tech part is easy. The compliance part takes work, people, knowledge, but it's understandable. I wouldn't say it's easy, but it's work. You can do it. The distribution part is the hard part. And so
Totally.
how many wedges truly exist? I think if you take a combination of industry and region, then yes, there's a lot of different micro pockets. But if you look at, say, let's assume you did a kind of market mapping of industry times region for the kind of key neobank use cases. The question is, how many of them are actually underserved? And I think quite a few of them will be, but then there's only so many neobanks. There's only so many kind of winners that can exist at a certain scale. Now there can be many niche banks, who top out at like, I don't know, I'm just going to throw out a number, 5 million ARR, 10 million ARR, right? There's probably a lot of 10 million ARR businesses out there that are not venture fundable. And actually, maybe we end up in a world where there's just thousands and thousands of these neobanks. And having a neobank is going to be as synonymous of like having a large Instagram following. It's like, hey, I've got...
You think we're going to end up in that world? That's actually one I don't know. Yeah.
I think I don't know if it will happen, but there are certain... I'm suspending my disbelief because I think there's certain beliefs that folks would have, say like pre-Uber, like why would you go into a car with a stranger who will take you from A to B? And like the kind of core behavioral shift was that we could trust another person because of a broader system around them, right? And so when I think about why can't there be 1,000, like it's tens of thousands of neobanks, and my kind of instincts say, well, no, because we need to trust an institution. It needs to be like a firm that you feel comfortable with your money. And I think that used to be the case for sure, especially for millennials and above. You bank with, banks who have buildings that have concrete pillars outside, right? Like that's how we associate trust. But increasingly, that trust is being acceptable from other large fintechs that we trust. And what I mean by that was a poor way of saying that. I think we've learned to trust large fintechs as well and people behind those companies. And so there are brands such as Revolut and Monzo in the UK, and Chime in the US and so on, where a fintech has built a brand where people feel comfortable holding money. And I think that can continue to, as we're seeing these neobanks who have, millions and millions of customers, clearly newer brands can develop this trust. And then going down further one more level, if you are in a community, like a local community, I think about community banking, but it could be like an online local community, then why can't that person have trust? Right? And so if that person can have trust, then all of a sudden, one of the key things that I was thinking about would prevent there being all these different neobanks is gone. And actually, you trust this person, you trust this brand, you trust the system behind it. It has insurance. It's built on some framework, call it like a SOC 2 or FDIC, just some acronyms that people don't necessarily understand, but they just come to learn that means safe, right? On a first principles basis, I don't see why that can't happen. Now, whether it will happen, that's a different story altogether. That's like a path dependency problem. But theoretically, I can see there being a world where, hey, like everyone from my town or from my community, who we all think the same, we all went to the same college, and we all have these particular needs because we invest over here and sell over here and do this other thing on a part-time basis, all use this bank or all use this app for our banking. So yeah, I'm not going to rule out that there could be tens of thousands of these fintechs. Whether that actually happens, maybe we end up in a big consolidation fest in 2 years from now, and it ends up being just a few. But I wouldn't. I'm watching my eye. I'm watching out for that because I'm very keen to see people bootstrap these things, and how the consumer behavior changes, or even the business behavior changes, in this new world of trust online.
Cool. Well, that's an exciting idea. I've definitely heard people talk about that, and I also don't know if it'll happen or not. Okay, I got another question for you. What's not being said enough in the stablecoin industry space? You're across it more than almost anybody else in the world. What do you think we'd like to see more of?
This is going to go directly in the face of that last comment.
Perfect. Love it.
The infrastructure isn't quite there yet. That's not what's been said enough, and I think that's fine. I don't think that's not a knock on anybody. I think that's just where the industry is. I think it's built for developers. That's good because it's the developers who are doing all this innovation. But we're only okay. If you assume it's not fair to just say Bridge were the only ones, like there's lots of other infrastructure that was built, but I think Bridge popularized it because of the acquisition. So then we're 2 years in. We're 3 years in. Like, and there's been a lot of iteration and figuring things out. So yeah, we've got a long way to go to get to kind of really, really high quality enterprise level infrastructure. I don't even think that's a single thing. I think that's lots of different shapes and sizes that will be built by lots of different infrastructure companies. And so I actually think that, I can name 5 infrastructure companies right now where you can build a neobank. I think there'll be more. And I think they'll each, find a different permutation of customer to sell to, and they'll all have business because there's just so much more to build on top of these things.
Love it. Yeah. So we're early, is what I'm hearing. And tell me like 1 or 2 or 3 parts of the infrastructure that you think are underbuilt right now.
So yes, I think this is really broad, but payout networks, on-off ramps, compliant on-off ramps, even just dollar stablecoins, let alone non-US dollar stablecoins. Like that's a whole other conversation to have. So I won't have it right now unless we can. I've got lots to say there, but if you think about just the stablecoin sandwich, don't even need to go further than that. The ability to pay out or to collect in a given country, even the US actually, because the on-off ramps in the US still needs improvement because of ACH sucks, right? Not everyone has RTP and Fed now. There's a lot of work to be done to just maintain 24/7 liquidity at scale.
Yeah.
And so for individuals and consumer applications, like sure, if you're in a country that has a real-time payment network for consumers like Pix or UPI, really good, actually. Some companies have really made that work really well. As you get to larger scales, it becomes more challenging. And so that needs to still be built out. And it's not just a tech problem, it's a liquidity problem. It's a coordination problem. Liquidity problems are typically coordination problems. You need to funnel demand through a particular point or coordinate multiple bits of demand through a particular point so that people can efficiently net it and manage their books to provide the service that feels like low spreads and instant settlement. That needs to happen in lots of different locations. Compliance, part of that is we're still catching up with regulation. Part of it is regulation is changing. Our regulation doesn't exist. So there's nothing to catch up to because it's not there yet. So we've got to wait for that to happen. And then the trickle-down effect of that throughout all the different parts of the infrastructure, particularly the banks. At the end of the day, the banks are still the arbiters of fiat, and their tech could do with improvements. And so there's stablecoin infrastructure, but then there's wallet tech for banks or wallet tech for companies that are plugged into the local settlement systems. That needs to happen as well. So I'll start there. I think that let's see, card issuance. There's a couple of companies, but Rain is still just so far ahead. They've done such a good job. And so I'm kind of waiting for more companies to develop to get to
I was surprised to
scale.
see a Reap get acquired. I was like, Reap feels like a player that could be a good second, chariot in that race.
Yeah, I mean, maybe that's why they were acquired, right? I mean, there's quite a few. Oh, you got Reap. There's like 5 or 6, even more so. I mean, some are being acquired at the moment. Some are like you mentioned, Reap as well. Bridge obviously has access to Stripe's issuing infrastructure, and so I'm waiting for that to be built out because that'll eventually be good once it's done. But right now, if you want broad coverage, you go to Rain. Like they are the guys right now. And it's just going to take us some time before everyone else catches up, and so you have more competition. And then you can keep going down the stack of where else there needs to be work. But right now it's good, and it could be There could be more competition. There could be more choices and also more coverage. But I think if you're in the business of moving money, especially at scale, then you're talking about on-off ramps and plugging into local payment rails with banking infrastructure or like local fintech infrastructure. And then you have to do that, and you have to wait for the countries that don't quite have this regulation sorted to add the regulation so that we can get compliance, so that we can have compliant on-off ramps, right? Yeah, it's kind of like it all trickles down from there. So those are the things that I'll say, and at least that's quite top of mind right now because of just B2B payments and cross-border payments and treasury being a clear use case that people are adopting right now, and cards and kind of embedded finance as another clear use case that's being adopted right now. And actually, as I enumerate those things, a third one comes up, and that is yield, particularly compliant yield. It's a tricky thing to say because there's a lot of DeFi yield sources that are not necessarily compliant based on the jurisdiction of the country where you're trying to build your application. And so there is the kind of non-custodial, it's self-owned route, where it's like, hey, there's no, I don't need to comply with that particular thing because I'm not the custodian, it's the user. That's the argument. But that assumes the user is comfortable with DeFi yield. And in many cases, that's not the case. And I think if we're going to scale to beyond crypto native, we're going to have to figure out a way to get the benefits of on-chain finance or on-chain capital formation, or even on-chain ledgering for more efficient movement and settlement of these assets with a safe and compliant underlying asset. And so there's lots of people working on this. There's lots of different ways that this can be solved. There's a bunch of interesting companies, and so happy to chat with folks who are keen to learn more. But I think that is another key unlock where you can say, okay, for I don't think you'll get it anywhere, but for these 6, 7, G7 or G20 countries or for whatever countries that have kind of clear or clearish regulation, here is a on-chain yield product that is compliant at different areas of the risk curve. So here's the, low risk kind of treasury yield product. Then here is the kind of corporate bond, like AAA corporate bond type product. And then you can kind of go up the risk curve to, whatever you want, like investment grade, non-investment grade, private credit, and so on, in a way that handles the kind of consumer disclosures and the safety, and maybe even insurance. And so to make that happen, actually, I think you probably need to work within the existing kind of securities regulation of each of the particular countries. And there's just a lot of work and innovation, I think, that can happen there. And it's not all purely about the tech and the blockchain. I think there's some regulatory innovation that needs to happen so that we can use this technology to deliver assets on the appropriate risk curve for the individual. I think that as a concept, I think is something that we should aspire to in general. Lots of people are at various places on their journey of understanding investments and the risk that they want to take, and how to grow their balances and their salary and their kind of overall savings for retirement and so on. That's a whole other conversation. AI, I think, will definitely help there in terms of a personal financial advisor and so on. Okay, but then assuming that somebody has an understanding of how they want to reflect their risk appetite from the savings and something highly liquid to taking a bit more risk with something that's less liquid over a certain time horizon that fits in with where they are in their career, let's assume you could reflect your desire from a risk perspective. You should then be able to express that and get those assets. And that's the part that's both those sides of that equation don't work today. First of all, understanding and then reflecting that risk appetite, then deploying it into the right assets. And I think, in a future world, your AI would deploy it for you. It would recommend and say, it would understand who you are, what you're trying to do. You say, hey, look, I'm going to get married soon. We probably need to save some money, have some that's liquid for the wedding. Plus, I've got this job now, or you work in a firm, you got some savings, so you got some carry, or you got whatever. You should be able to put all this together, have a financial plan, and then the output is, well, you should invest in this, in some bonds. I know that you're interested in SpaceX. I don't recommend it, but I know you like it, so we're going to add that to your portfolio, right? It's like it should be like that, and then boom, it just deploys. And for that final deploy step to happen, it needs to be compliant, and it needs to be in a way that's 24/7 on chain. And so there's just so many things to solve there. But that excites me. I think that will happen over time. That's the holy grail. How long it'll take for us to get there is a question.
Longer than people will
that's
want.
the innovation.
I bet. Yeah.
Huh?
My takeaway is these things will take longer than people want, for sure. Yeah.
Yeah, because I mean, the closest thing to that, I think, in the US, in your Robinhood account, you could probably get there quite quick. Like they're not that far off. They've already got, they're getting more and more assets.
That's
in
true.
that single application.
Maybe I should clarify and say longer than like blockchain, on-chain people want. You can actually do a lot of what you want, and you're describing off-chain already.
Yeah, and I think the question is all about access. And so if we have the greatest capital markets in the world in the US, there should be an answer to the question of why can't somebody in X country have access to the same things? Yeah. Sometimes there are really good answers to that. Like, okay, fine, cool. But if there isn't if they're not sanctioned, if there isn't like a capital control or other political reason for not wanting, draining savings away from their local savings pool, sure, I understand that. That's like a political or like a sovereign question. But if there isn't a legal or a political reason, it's purely just a technology problem.
Yep. Yeah, totally. Well, we're getting low on time. I feel like we went broad today. Now I'm seeing some juicy sections to go deep if we ever do another episode. So appreciate your jamming with us. Appreciate all the synthesized knowledge you've gotten over the years that you're helping people understand, both here and through your other work. As we wrap up, I'd love to just hear any unrelated stuff that's not about work content that you've been enjoying in the last month or so.
Yeah. Man, the one that I had was about work. I was, I guess, there's a book. I listen to Lenny's podcast. I'm a product manager by trade, I suppose. So Lenny's a really good resource, and he was interviewing this guy. Oh man, I'm gonna forget his name. CEO, founder of Zynga.
Yeah, something Pincus maybe.
Yeah, Mark Pincus. There you go.
Mark Pincus. Yeah, there you go.
And it's very interesting because I spend a lot of time. I build investment products or like enterprise products, and this guy is like the consumer entrepreneur. Mm-hmm. And his book is, I think it's called like Life at the Speed of Play or something like that.
Yeah, I've seen that.
Yeah, I read that recently. I highly recommend it because there's just a lot of insights that he developed from consumer products and building consumer products and building viral consumer products, I should say. That I think translate to product in general, particularly in the world of AI, where it's becoming so easy to build things. And the question becomes, what are you choosing to solve? What are you choosing to build? So I'd recommend that, but that's a bit close to work. And
that's
then
okay.
Other than that, I'd say I recently watched The Odyssey, of course, classic.
Oh yeah, I've been hearing about that. I haven't seen it yet.
Yeah, look, I mean, watch it. Just go watch it. Yeah,
do yourself a favor.
He's done a good. Of course, Christopher Nolan. I'm a big fan of like many Christopher Nolan movies. I think my two favorite movies are Christopher Nolan actually. Interstellar. I'm a big space nerd.
Such a good movie.
It's so good. Yeah. Sorry, Interstellar, of course, and then Inception. Right, and then Tenet is great, and then this is also great. And I think when you go watch it, they've nailed the soundtrack. Like they've done such a good job of making it so gripping. And I think if you listen to it without sound, or maybe if you watch it on a plane, you don't have good speakers, it's not going to be the same. And I know most people will talk about go watch it in the IMAX because of the way that it was shot. Like I'm not like a videographer. I can't tell you exactly what the difference would be if you do or don't. So I would say go watch it in IMAX, but I'm not going to hold you against it. The sound quality inside the cinema of the score and what it does to the story is the part that I go for.
Oh, there you go. You got some great non-work stuff there.
Yeah, I'm glad the movie came out recently.
Awesome. Well, Chuk, thanks so much for your time. Really appreciate having you on the show. I really think you're doing great things for the industry, so keep it up.
Appreciate it. And thanks for having me on.
You bet.
Awesome.